If you intend to use simple moving average in your trading, whether you are trading Forex, stocks, commodities, or crypto, then you will want to watch this video because I am going to show you exactly whether or not the simple moving average actually works. And this is backed by research that we have done through our past trading stats. All right, so let's go. Okay, so this is where I'm going to talk about exactly what is simple moving average and how exactly does it work and whether or not should you use it and incorporate it in your daily trading itself. So it doesn't matter what vehicles you're trading, whether you're a Forex trader, stock trader, crypto trader, or whatever trader you are, because simple moving average is basically a moving average, right? That is, so what we have here, for example, this is Apple, right? This is Apple, and then this is the 10 moving average, which is the simple moving average, right? So simple moving average basically is the average. If let's say if this is a 10 moving average, right? If this is the, let me show you again. This is a 10 moving average. So what this means is that it is a calculation of the last 10 bars, the average of the last 10 bars, right? So when you want to use simple moving average, most people use it by using the crossover of the, let's say, a shorter time frame moving average. In this scenario, I use the 10 and the bigger moving average. So in this scenario, I use the 50 exponential moving average. So what usually happens is that people play the crossing, right? The crossing. So for example, let's say the 10 crosses the 50, and the moment when it crosses down, this is what we consider, or what traders call it as the death cross, right? And the moment say, so for example, let's say at this point, the moment when it crosses up, it is considered as the golden cross. So this is usually how it works. If it crosses up, it means like a buy and the market goes up fantastically. And the moment when it crosses down means the uptrend is over. So as you can see on this example alone, this is beautiful, isn't it? Right? It shows that if, let's say in this scenario over here, I go for the buy, and over here I go for the sell, and over here I go for the buy, and over here I go for the sell. Woo! You would have made great profits. And these are exactly the stuff that gurus or trading courses out there, they actually teach you. Just trade the simple moving average cross, trade the golden cross, trade the death cross, and you are set, right? So does this actually work? So back at Asia Forex Mentor, what we are doing right now is that we have back tested, right? Pairs after pairs, stat after stats of be it Apple, right? Which is, it could be a stock, whether is it crypto or whether is it Forex pair, right? And we have back tested the stats so this is how we run a stat. So for example, let's go back to the Apple example. How we run the stats is simply like this. The moment when it crosses with a bullish bar over here, let me zoom in. Okay, let's say here. The moment when it crosses over here, when it crosses and it forms like kind of like bullish bar, we will go for the buy. And then the moment when the EMA crosses back down, right? It crosses back down with the death cross, which is here. That's where we get up for our trade. That's where we go for our sell, right? We get up for the trade. So how we calculate is this. We calculate the entry, the point of our entry. Where's my pen? Okay. So let me show you. This is where we have entered, right? And then this is where, at the crossing of here, this is where you would have got out. So the distance from here to here is the profit target. And then the stop loss would be from the entry point over here, maybe you just go below the bullish bar or below the crossing. So this is our stop loss. So this is the risk, this is the reward. And this is kind of how we run this test, right? So let me delete off this. So what this means is that, so for example, over here, if we go for the buy over here, the moment when the market crosses down, so we will run a test, right? Let's say go for the buy, we go for the buy over here, right? This is the buy. So the stop loss can be below here. And the moment the stop loss is below here. So the moment and the market went up, right? Let me zoom this a little bit more so they can see. Okay. So the moment when the market crosses down over here, which is here, that's where we got out. And as you can see from the entry point to the point where it crosses, that's where we got out. It's here, right? So this is the entry, this entry to stop loss, and this is the profit. Still a little bit of profit. So we ran this test on the three pairs. It is Apple, it is Bitcoin, and Euro USD for the last 1 year of stats. Okay. And we have found some interesting stuff, right? We have found some interesting stuff. The thing about moving average is that there are pros behind it. The pros is that it is useful for identifying trends. So for example, the moment when it crossed, it could tell a trader that the uptrend has ended and then the downtrend has begun, or the uptrend has ended. So if you're buying, probably it's time for you to get out, right? And but the cons is that it is slightly later at times. It identifies the trend late. It is not the first indication that boom, it's going to go for a sell. Usually when the market drops, that's where the crossover crosses, right? So it's a little bit late into the game, right? The next pros is that it works well as a dynamic support and resistance level, because price do respect the level. You see, for example, when price goes back up, it tests the level. So it does respect as a support and resistance level. The cons is that it does not provide a very good entry or exit, like I mentioned, because it's late. So the entry could be later, the exit could be later, and that affects trading itself. The next pros is that it's flexible and is customizable to your trading setup, right? What this means is that you can add this to your trading setup or however you are trading to help in identifying trend change, right? But the next thing is that sometimes it provides choppy signals. So let me run you through. So for example, if let's say we go to, let's say Euro USD, right? Euro USD, this is the 4-hour chart. So what happens is that there could be times whereby you go for sell, it looks nice, and then we get out here, it looks nice, right? But there will be times whereby it's choppy as well. So what? If you go in at crosses, you are screwed. And then there are times whereby it may work. So maybe we got in somewhere here, but the moment when it crosses back down, we got out somewhere here. Yeah, we make a little bit profit. But what happens more often than not is that there are all these crosses over here that could actually kill you. So if we just play this moving average to the book, I know some EA run on this itself, whereby they play on the crosses. The cross, you go for sell, you cross back up, you go for the buy, and so on and so forth, right? This strategy only works well if the market is trending, right? So it works well when the market is trending. But the moment when the market goes into a sideways channels like this, you will be screwed. You will be screwed. But so when we ran our tests, this is kind of what we found, right? So for the Forex pairs, out of the last 10 trades, so we just average it by last 10 trades, the win rate is 1. We won 1 out of the last 10 trades because the market is choppy most of the time, right? And then it trends and then it chops again. So by that itself, we only won 1 trade in Euro USD. In stock, Apple, for example, we ran a test on Apple itself, H4 time frame. We won 3 out of 10. A slightly better win rate than the euro dollar. For crypto, we ran a test on Bitcoin, right? Same thing on a 4-hour time frame. The win rate was 2 out of 10. Okay, but here's where things get interesting, right? Because when the market trends as we have seen in an earlier example in Apple, it trends quite big before it drops, right? So therefore, the risk to the reward ratio is actually quite big, right? So because when it trends, the risk to reward ratio is actually quite big. For Euro USD, the risk to reward ratio was actually 10.67. So you risk 1 is to 10.67. That was the winning risk reward ratio. The rest was all losses, right? For Apple, the risk reward ratio, the average risk reward ratio of the 3 wins was actually 33. So if you risk 1 is to 33, which is huge. For crypto, we only won 2, but the average of those 2 is 47. 1 is to 47.65, right? So that's where we run the profitability gain test. We won 1 trade in Forex pair times 10.67, right? Minus 9 losses of 1%. So we just average it at 1%. We made 1.67% out of 10 trades, right? Okay, yeah, it's probably not really winning or so. In stock, right? In stock, what we did was that out of the 3 trades that won, they averaged at 33, the risk reward ratio of 33.19 minus the 7 losing trades, which is with times 1%, we actually made 92% on that. And for Apple, for Apple, we made 92%. For Bitcoin, we made 47, 2 winning trades times 47 risk reward ratio, right? Of that, the average of the last 2 winning trades minus the 8 losing trades times 1% loss, we actually make 87%. So now this changed the dynamic of the game. If you look at it in this manner, right, by just trading the crossover alone can be profitable. So now traders may start thinking, all right, so now that you run through the stats, I know the win rate sucks because most of the time the market is choppy, right? So that's where you screw you. But then the wins that if you could actually capture can actually make and the return, the reward that you get from there can actually cover the losses and more. That's true. That's true. However, if you use this indicator alone, just the moving average crosses alone, let me ask you this question. What is the chance of you getting and capturing the entire, so out of 10 trades, for example, let's say euro dollar, you only won 1 trade. What is the possibility of you capturing that 1 trade compared to, or the possibility of you missing that 1 trade because you were slipping, or because you weren't paying attention, or maybe because you deemed that trade may probably just chop as well and didn't turn out right? Yeah. Or let's say crypto, Bitcoin, we have 2 wins, right? So what, in terms of human psychology as you trade along the way, are you be able to keep it all the way? Or will you be able to enter on those trades? But those big runs is based on our last 10 trades. But that also happened because in the last 10 trades, in the last 1 year, there was a big either upswing or a downswing, and that happened because of COVID. So that made a tremendous bear drop and also a tremendous bull run after that. So that may not be as accurate as a normal year that you will be trading. So that represents the high risk reward ratio that we have. So what I'm saying is that by using the SMA alone as an indicator, I would not recommend because the win rate is too low and the chances of you hitting that plus combining with the risk reward ratio may not happen, although the stats may say so, right? So more importantly is that if you are using the SMA crossover as your understanding when you trade, regardless of whatever pairs you are trading, right? Do use it as an overall direction, but do know that when it chops, that's where you know that, hey, you wouldn't even be wanting to use this indicator alone. But this is some interesting stats for you to run itself. So I'll be happy to hear your thoughts about the SMA crossover. My verdict on the SMA crossover itself, out of 10, I will probably rate it a 3 out of 10. So this is something that we'll be doing every single week. We will be running through all the various indicators, all the various patterns, and then we will be running our back test through it. And we will be, if it's good, I'll tell you it's good. If you can stand alone, I'll tell you can stand alone. And then we'll run stats like this. So do like this video, do follow our channel, and let me know your thoughts in the comment section below.